Samantha is a macro to micro strategic technical analyst, educator, and trader. She grew a small technology company, a family of 60, for 10 years before selling it, and has been actively trading and investing since 2008. Samantha has a unique perspective in scanning, synthesizing what will move, why it is moving, and how to trade it with risk-defined options. She specializes in outliers with velocity on any time frame. With a chart pattern and volatility focus, she advises day traders through asset managers. Her mentoring helps clients fill the gaps between guessing and knowing when to enter and exit an options or equity trade based on macro value, sentiment, intermarket, and technical analysis. Since process and performance matter, she details both for members with real-time brokerage-triggered trade alerts sent via SMS, email, and the web. You can find her fishing for intraday and swing trades while providing risk management, trade setups, and mentoring in her live trading room, brokerage-triggered trade alerts, and macro to micro newsletter. Samantha, where are you broadcasting from today?
Andover, Mass. Can you hear me?
I can. Andover, Massachusetts. I think they have some famous colleges near there.
Just a few, Boston-based. How are you, and happy summer?
Well, thank you. I'm just about to take off for Europe myself. So you have 5 minutes before the hour, and then I'll hand out the next batch of prizes, and I'll be listening to your presentation with rapt attention. So I'm muting myself now. You have the screen, and I see profiting with macro to micro trading.
All right, so we're here. I am very glad to be here, although I could have scheduled this a little bit better, forgetting when I did this months ago that we would have the FOMC minutes.
Yeah, I assure you it was random chance, but not only that, it's the most important Fed meeting in 30 years. No, but no pressure. You could continue with your presentation.
No, this will be spinning plates. I'm telling you right now, because I normally run a live trading room during FOMC, of course, and Powell's presser.
Hey, I have a forecast for you. I predict in the next 60 seconds, we get extreme volatility.
Yes, I'm with you on that one. So literally, if Fed sticks to 50 basis point, which was guidance, doesn't surprise, short the rip. If Fed surprises and hikes by 75 basis points, which is now 94% chance, short the rip. If Fed surprises a lot by hiking a lot with 100 basis points, which is bond bullish in the short term, I'm still going to short the rip. So that's basically it. My presentation in a nutshell. So this, what you're looking at right now, is my Slack client workspace where I post my market thoughts, and also the contributors, which I have on my trading desk. And as you can see, I post a lot in regards to the macro, which is the backdrop against which I then define the micro. The micro, obviously, the actionable trade setups across multiple time frames, chase, swing, and trend. Also commenting on cryptos and global sector rotations. Right now, it's all about the Fed. That's all that matters. And I do mean literally bonds matter. So as I wrote just this morning, but this is a huge sell-off that we've had. Hold on. U.S. did actual 1.6. What? It's going too fast. That's it. 75 basis points right in the middle. Okay, so we have Fed surprise. My alerts go off. Fed hikes interest rates by a surprise, 75 basis points. And why this matters, and this may not be an evergreen presentation, but it's very important because guidance was only 50 until the Wall Street Journal article just a few days ago. And in that interim period of time, then you had basically a very large bond movement in the terminal rate. And for those who may know, it's very disruptive to the bond market to have surprises. And we've already dropped 10 trillion in global bond value because of this bond rout. So it's actually a big deal. The other aspect that I really focus on is on market structure, which is gamma. Will that underpin a short covering rally? If so, for how long? Not to mention risk events that occur, whether it be the yield spike, the dollar spike, the oil spike, all of which I am very active in predicting. So I am basically what you'd call in the prediction business. I have been featured in multiple, national media outlet kind of thing, because I really am comfortable making predictions. It's completely comfortable for me. So to back up just a little bit, I am, as John put, even though that's a really old bio, fascinating, where you found that one. I am a discretionary trader. So I do advise clients from retail to institutional. I focus on the chase, which is right now going to be happening because this is the biggest move in interest rates since 1994. And the yield, the 2-year has just fallen about 13 basis points. Doesn't matter. I still see this as a short-term interim move in a long secular change or trend reversal. And we'll talk about that a little bit more. But that's part of what I'm focused on, is these durable trends at inflection points that move markets, stocks, currencies, commodities, cryptos, and bonds. So I'm using this as a backdrop, the macro, combining it with my intermarket analysis, and I'll show a little bit of that to you. Test always. And then for actual trade setups, it's based technically, low risk entry, price targets, stop losses. And that really, it kind of epitomizes that whole risk reward of when to enter a trade, and then having the confidence, first of all, to enter a trade, but then also having an idea of where it's going so that I can encapsulate that trade setup for clients. So I'm managing trades for clients. I'm warning of potential risk events. I'm explaining what's happening in the market so that they can have a better idea of where to, where to collect profits or portfolio management, which is a really big aspect. It's not just me that I'm, trading my book, but I have clients that are not only trading my calls, but they are managing assets for their clients. So in other words, portfolio managers and the rest. So I really care about this, this market analysis that I deliver, research that I deliver to help them navigate. So recently I did, and I'm going to back up a little bit to see, we've got a little bit of time before Powell gets up there to present. I want to see very quickly how we're doing. Yeah, we're just going to wait until Powell comes up, aren't we? Yeah. All right. So dollar is rising with yields, by the way. And most importantly, for me anyway, the euro is about ready to fall over. And I have to kind of intervene here because this has been a short, for example, macro to micro. Head and shoulders, it bounced into resistance at 1.19, and every drop and pop into this 10-week has been resisted, with the exception of one period of time, and then it rolled over. Every price target has been taken out. My next level is 1.03. This is important. The euro, the ECB coming out this morning with a quote unquote emergency meeting. And then obviously this propels the dollar higher, Dixie above 105. This also propels interest rates. And we have a very, very key level in my book that I've been watching for many months, which is 3.33. Above is very bullish. So we're getting into a place of more market risk, despite Fed's efforts to surprise us with a 75 basis point hike to imply that they're hopefully on the job. In other words, they're going to go after this inflation. I don't personally believe it. So I've done some writing about this for my clients, but I also was featured in a Market Watch article, which you can grab. I absolutely timed the top for the bond meltdown from August 2020, and I have stayed very consistent and true to it. Also, the tech sell-off from November, I have some very good risk indicators that helped me spy this rollover in NASDAQ underperformance. And in fact, I did a presentation back in January of 2021 It was a look ahead for Stock Charts TV called Charting Forward. And I made my big push, despite all of the others, every single one said we were going to higher highs. And I was the one that said we were going to fall 20%. So at the time we were 4,800, 3,800 was my price target. We've obviously exceeded that. And my main point was NASDAQ underperformance. After 13 years, it was done. So I was not any longer a bull. And I charted that, got mentioned. Obviously, that worked, and it's continuing to work. So my macro to micro framework is very much focused on timing inflection points. And so far, just for an example, in this Market Watch article, I have a higher oil, higher interest rate, and a higher US dollar theme, even with the Fed overshooting, if you will. It's 50 basis points to 75 basis points. It's just not going to be enough. So I'm still very bullish, oil, yields, and dollar. And to date, these have worked really well. So baseline bet in July, I came up with a theme. It happened to be a durable theme, and it's still in play 2 years later. Things over paper and inflation is sticky. Obviously, I am an inflationista. Bonds have, inflation has not peaked. I have stayed very, very focused on that macro print, and I will stay very focused because that makes all of the trades possible. The bond short, the equity short, that's risk parity broken. The dollar higher, the yield higher, that's emerging market contagion. And my higher oil call is still working on its 160 crude price target for this summer. So I'm not done. Bonds, I had mentioned very strongly to clients that I thought were done going up and yields were done going down. That continues to prove itself out. And baseline bet was also back in December of 2020 that energy would outperform tech in 2021. It did. Then again in March of 2021, seeing how strong the energy sector rotation actually was, I doubled down and I said, not only is oil the inflation hedge, but crude will double within a year. Did a presentation back in October of 2021. This is the actual chart. And I wrote, here we are, okay, October of 2021. And in March of 2021, when we were at 65, I said we would double within a year. By March of 2022, we hit $130.50. So we did double. Then in March of 2022, I doubled down and said, guess what? We're going even higher. So we're going to double again by March of next year. So we are on this path of unsustainability. In my opinion, equities are not done going down. Strongly believe that. I've been a big Bitcoin bear. I've been a big tech, China ADR, or the Chinese internet stocks, SPACs, all of that. Anyone who follows me on Twitter or has been a client for a while knows weaving in and out of these counter trend bounces has not deterred me from my goal of keeping clients safe from thinking we have a capitulatory low. We don't. We have lower highs. So this is basically my whole premise, and it hasn't changed. And then here is baseline bet that we would have even more bond sell-off. When I wrote an article, again, October, again in December, that we would continue to trade lower in bonds, crude would continue to trade higher, NASDAQ would continue to outperform, the growth to value rotation basically would continue, and it has. The big issues right now have been in foreign exchange currency, the yen, the yuan, the euro, and those continue to fall, which is very dangerous for equities. That volatility will seep into equities. So I guess the point I'm getting at is not only am I making these market timing calls that are macro in nature, but then coming into areas for clients of defining how to trade the euro short with ETFs, with the euro dollar trade, with basically all the bond, whether it be ZB or whether it be TLT, with all the bond positions that we also play. So it's one of those deals where I had to go and put together a really good outlet to share all of this analysis for clients. And I decided I would, create a Slack client workspace. It's called my fishing club membership. Okay. So in here, you can see where I put my analysis. It's very detailed. A flash crash, I had warned last week before the gap down on Monday to be absolutely careful because I expected to have a flash crash. I am very active in trading VIX. I currently have a bull risk reversal in play that I had set up a week ago before this recent spike. Long story short, I'm very active in posting my market thoughts. Macro to micro is an area where I get a little bit into the weeds with what's going on. So we have a new inflation problem. For example, consumer price index rose, but it's not just goods. It's actually services inflation that's going to stay sticky now. And I talk about when these economic data prints come out, why it matters and why I'm still an inflationista and why it's going to continue to raise the risk of recession, et cetera. So this is a little bit more for those who are into the macro or want to understand the macro. Not everyone does, but I like to educate, right? Not just trade. I run a live trading room, and that is where we do a lot of the chasing and setting up of swing and trend trades. But this macro to micro support is most definitely to help clients understand why things happen the way they do. And this is my literal interpretation and where to take care. Okay. So the secret sauce that I also kind of really focus on is what I call my intermarket analysis. This is something that is very underestimated, but I consider it absolutely essential. Like I have been talking about yields for quite a long time, long time. Down here, this happens to represent the 20-year. I can show you the 5-year. It doesn't really matter. But the point is, again, Fishing Club service is for anyone who wants to understand the intermarket analysis, the macro implications, as well as trade actively across all asset classes and timeframes. But I will identify that we have a big risk of higher yields. And then I will go in and I will talk about why it's a big deal. Rate of change, it's just getting queued up to move higher. So the point is, this will be also kind of the background, which is geeky, but it's very helpful for those who are interested, especially CMTs and portfolio managers and the rest who are really looking for my analysis on breadth and volume indicators and all the stuff that really helps me to identify that we are doing some major reversals in trend. So for example, I've been interviewed by IBKR a few weeks ago, Interactive Brokers. And I said, we walked up the mountain and then we had a nice picnic for a year. And then we are now, walking down the mountain. This is obviously not SPX. It happens to be New York Stock Exchange Advanced Decline, cumulative. What the heck? I will chart anything. And then I'll put the index underneath to kind of identify where it has rolled over, where it's hit resistance. And every time it has come up to these areas, I've said, careful, that's exactly where we're likely to get rejected. So I can do this viewing of technical analysis at the same time I can do this intermarket analysis, at the same time I can represent the macro risks, not in hyperbolic mode, just in reasonable, logical, farm girl kind of ways to say, hey, we have a new Fed regime. Inflation's not transitory. They admitted it in November. We're going down the mountain now, and any bounce is to be shorted. So part of the risk management is, first of all, having a really good system, right? And then the other part is in actual application. So I'm not alone in this particular sharing of analysis, although mine is much more detailed. I have a group of contributors that are on my trading desk, and I want to kind of showcase them because I'm not the only one that's posting chase and swing and trend ideas, which, by the way, this is with stop levels as well. So we've been very lucky to be long the energy basket since the beginning. This is really a beautiful thing as far as portfolio returns. But my point is, whether it's something like a Carvana short which I will detail, and we literally entered at 245. And every time it hits a key level, I keep saying it's still going lower. We're now at 22. I see 8. So the point is, I'm going to update these. This is a swing short, obviously within a tech sector. These are trend longs, which are obviously all related to energy plays. Chases are a little bit different, right? So, and by the way, Rithika and Archana and Tiffany are trading room moderators, so they help me stay on top of my on my chases as well as swings and trends, and they run their own channels. So let me kind of talk about that. Archana posts all of her trades. She's an advanced options trader, so she is using a premium basically to buy or sell. Whereas I am only going to use it selectively, like my VIX bull risk reversal. But otherwise, I'm tremendously focused on directional plays and, you know, puts and calls. And I'll show you how I do that with adding time. Jordy is a full-time commodities trader. So we're blessed that because I have this theme of, you know, things over paper, which is hard assets, that I've got a fabulous commodities trader who gives us tons and tons of value in regards to the global and domestic commodities market. I am beyond thrilled that I have Craig Shapiro, who is a hedge fund manager and a client for years, who I recently brought in to run our Edge product, which is the more institutional offering. So, you know, he can help them as they sit on Bloomberg and the rest, and his calls are fabulous, and he shares his analysis as well. I have an oil and gas trader, Robert, who has been doing this his whole life, and before that, his father. So basically up in Halifax, and just, we're talking core oil and gas focused and incredibly, you know, geared to the fundamental side of the oil and gas equation. Rithika, she is runs my Discord product, and she has a phenomenal nose for momentum. So she, for example, played that counter trend bounce today with Microsoft calls and made 100% return on her options, because she's playing anything that's going to move with volatility on a very short duration. That's not my game. It's really not my game. But I have folks that do it extremely well. Suda is a futures trader. All she trades is Suda. I mean, is futures. And then Tiff is my gamma flow absolute key contributor for single stock option gamma. So for those who are into options, you need to understand gamma. Negative gamma begets, you know, selling begets selling, buying begets buying. So the single stock option gamma flow is very important, as well as the indices. And literally, I've got something for everybody, right? So options galore, advanced, directional, momentum, short duration, gamma flow, from the whole market structure to commodities, oil and gas, and literally a hedge fund manager, all of them sitting on my desk to help support clients. So it's not just what we've got going on in my live trading room every morning and every afternoon, and what I'm posting for my secret sauce to my macro education and market thoughts. So that's how that works in regards to all of this kind of drama around the action of the Fed regime in a tightening schedule into an economic slowdown. It's a big deal. And I believe that this market is not going to see all-time highs again for a long time. And the oversold tech plays will stay under pressure for a long time. And the big risk now is some actual solid forced selling that hasn't even come into the market yet. But I think we're getting closer and closer. Watch oil, definitely it's a risk. Watch dollar, it's definitely a risk. And also yields. We did not have panic selling until just this week. That gap down on the weekly was as strong as the February 25th gap down of 2020, right before the 30% COVID crash. So take it very, very seriously, okay? Europe's in no better shape. Japan's experiment for yield curve control is in a lot of trouble. And no matter what, I think that this Fed hike that we have right now is going to be less impactful on inflation expectations. And I just continue to warn folks to watch the divergence, right? This is, I posted last month for clients. CPI was at 8.3, it's now 8.6. And this little bitty blip was the Fed before today's 75 basis point. So this is the largest spread in history. Are they going to raise to 8%? John would say resounding no. But the markets might bring us there. And that's the worry. So we have some risk in the markets. We're not done going down. I just wanted to kind of share how I share my analysis of the market and present it for clients, because obviously that's risk management. And I help clients manage their risk accordingly. So let's see, we've got, yes, I make trade recommendations. So that's, for example, nope, that's not what I wanted. I wanted VIX. Just looking for mine. Where are we? Yeah, I've got a lot of intermarket here too. And then my global is, where's my global? I'm trying to find exactly where I posted it. Okay, that's all prior. Where did it go? For some reason, yeah, I'm getting it mixed up because I'm not finding the exact date, but I had, oh, here it is. Duh. All right, so the VIX bull risk reversal was buying a $50 call and selling the $21 puts. It was a 15-cent bet, and it was basically a plan that I had into, I did it June 9th. It was a plan that I had for July. So basically that is already worth about 80 cents from 15 cents, and I have not closed it. So that is, for an example, I did it before, right before FOMC, and it made a quick 2,000% gain. So it's all relative for an individual to then decide how much risk they want to take on. Don't risk more than you're willing to lose. But the point is, I will post what I'm doing across, yes, everything. Oops, sorry. All right, so kind of getting back to that theme of market timing calls. This is, I can go over anything live that you want, because honestly, Powell's going to be talking and there is not a lot going on. VIX is still below 30. Gold is only up 1%. It has a lot to repair ahead of it, but once it gets going, it's going to be an all or nothing kind of trade. And then we have a likely reversal of whatever is happening right now toward the end of the day, but I'm still bearish big picture, as I just said. So in regards to risk management, besides having a durable theme that I then very closely follow, which then sets up like the energy is alpha, oil as an inflation hedge, and then sticking with that, right? Which I'm still sticking with. I haven't changed. I literally went on, paper and said, I'm literally calling for 160 this summer. And not only did 3,800 hit, but I've now had to revise it down to 3,400 because we went clearly through 3,700. But I had done that luckily back in March, April. But the point is, I still see 260 within a year. So how I'm getting there, again, I share that with clients. It's a little bit more of the secret sauce. And then the plays are going to be very defined proxies. For example, XLE and CVX, they're not going anywhere, right? Yes, energy, XLE and the rest will come under pressure in an equity sell-off, no question about it. And actually, oil tends to calm down in an equity sell-off. It's like one or the other, they're ballast. And once the market starts to settle a little bit, energy will start to rise again, and it will continue to rise until the market is priced back down. So for me, this is very much a dance. It's not going to happen all in one day, but there's no question that the strength in inflation has triggered the oil spike, the yield spike, and then the rotation to safety, which is the dollar spike. And it is the absolute biggest bond break in history. And I would contend it's also not done, which I know is very hard to take after, being down 17%, which is a big deal for the year, but it's not done in my estimations. So and neither is Bitcoin. Nope. And neither are stocks. Nope. So when it comes to doing this placing of actual trades, okay, I have a little bit different time frame. Okay. So, and Georgia, let me ask you that a little bit. Let me answer that in just a little bit. A little bit different time frame to answer your question. So time frames matter in trade execution. Low risk entry. I love it when it pulls back. Grab it then, because that's an opportunity where it's a low risk entry on its way higher, and vice versa. It's come up into resistance and short the rip for a reversal lower. Of course, I'm having a conviction on that, and I'll show you a time frame that I love to use before Powell gets on the podium. Chases typically last, for me, 1 to 3 days, and they're using options 1 to 3 weeks out. I often base them on an hourly chart time frame. I don't work from a 5 or 15 or even 30. I love the hour time frame. It's perfectly sufficient for my purposes. And swings are trades that typically last 1 to 3 weeks. So I'm using a little bit longer dated options, not so much, but 1 to 3 months out. And then I'm using a daily time frame. So technical analysis comes into play because I'm using trend lines and moving averages and standard deviation moves and, fib and everything else that you are comfortable and familiar with, you use. It's a personal experience. You just need to interpret the language, the market in your language, so you understand where support and resistance is. I have my system, and I share that live with clients every morning and every afternoon. And then I do custom analysis on their charts of interest. Trends are a little bit different. They're typically lasting a good 1 to 3 months minimum, and I employ options 3 to 6 months out. So I can roll those, of course, if I'm still confident about it. I can protect around it, selling calls, buying puts, if I'm in a counter trend rally, for example. So that's what's going on right now. The market is in a downtrend. Some stuff is absolutely in a very, very defined, protracted downtrend, the tech stuff under the surface. And some stuff is in a protracted uptrend, like energy, but they're still going to undergo profit taking. It doesn't change the theme. Even nat gas, it got walloped, right? Yesterday, it fell 18%. I firmly believe that's going to move higher. In fact, that was one of my calls last year, early, that we would move up to 4.5. If we held $4.50, sorry. If we held that, we were going to 9. And I was looking on a monthly. If we hold 9, now right now we just had a big wallop yesterday on Freeport, basically shuttering their facility for 90 days instead of the expected 21 days. And that sent nat gas down 18% and spiked European nat gas up a good 23%, because where are they going to get their natural gas? Russia has just reduced their Gazprom supply to Germany by 60%. So they're in an energy crisis, which is one of the trades I have recommended early and often around EZU, which is the Eurozone short, with the euro dollar trade, with emerging market and Germany and Japan. All of them are in trouble, all interrelated. And that was before the Russian invasion of Ukraine. So trends to me can just be rolling trends as long as they're working. NASDAQ had 13 years of outperformance, and now it is no more. It is just one of those things. It's going to be boom. And we can have some intervention too that comes into play, like the nat gas or oil. There's always air pocket of risk underneath where it can absolutely collapse. Happened to have that really nice timing back on Thanksgiving. I had warned clients the Wednesday before, and Robert helped with this tremendously. He's my oil trader. That the day after Thanksgiving is typically a extremely thin day, not just in overall volume in the market, but especially in oil. So I warned clients, and literally we dropped 13% in the oil patch, and it was a beautiful short. Still long, I'm still bullish the oil patch, but that is a tremendous drop, right? And it really messes up the implied volatility in your options. So it makes sense to either take advantage of that or protect, because I can see the danger coming in. This is just, that's my job, is really timing when this, when profit taking is going to come in and try to get clients to safety. For example, I posted this chart. I posted this chart to clients in Slack. This is SD. For those who might know, it's Sandridge. I had recommended them around $2. My first oil and gas recommendation from my theme of things over paper, which is basically just another way of saying hard assets over tech. Okay, so that inflation was going to be coming in, et cetera, et cetera. So once it got up here, which happened to be a monthly resistance level, I posted this and I said, recommended it at 2. It's now 26.85. Take care. Wouldn't surprise me if it comes all the way back down. I mean, this is 22.5. So that was posted. And where did we drop? Right here. Very nice pullback. It's obviously very sharp. Oil right now is also succumbing to some weakness, right? This is the attempt that they're going to try and weaken the price of energy to help this inflation mantra of peak inflation. Unfortunately, energy will pop back up like a daisy because of the supply deficit and the European war, and supply chain is inflationary, war is inflationary, et cetera, et cetera. So it is absolutely getting smoked. You can even use UGA for, these surrogate ETFs, but none of them have broken the uptrend. This is the 10-week. I use this religiously with clients. So if it trades back above the 10-week, the trend is still your friend. So if you're asking about XLE, for example, right now it has broken. I'm going to kind of clean this up. It is a beautiful trend, right? From this year, it just went higher, pulled back to the 10, broke higher, went sideways, tagged the 10, broke out higher. Here it is again, Keltner and the 10, and then just kind of one little wallop down, which happened to be during the China COVID lockdown. That was really a big deal. It hurt commodities badly because of the dollar yuan. And I'll show that to you in just a second. But the point is, it didn't last very long, broke out even higher. This is a gap down that's a little bit more intense, but it's not Friday. Let's see what happens. Friday close into next week. At some point, it would not surprise me. This is going to get bought and it's going to go even higher. So 50 to 100, that's an easy one. And then I can see this much higher in the next year with my higher oil call. So here's example and why the macro matters. This happens to be the dollar yuan, okay, USD CNH. When this spiked, it was exactly when commodities came back down. Oil and gas didn't come down very much at all, right? But XME, exactly, the exact date. So metals and mining across the board came down because commodity is the largest marginal buyer of copper and other commodities in the world. So it makes sense to watch the currency. So if you understand the correlations of how the macro can impact the micro, then you're absolutely ahead of the game. That's it. So my job is warning and teaching correlations. And then hopefully that helps clients kind of navigate around. I'm a big proponent of the 10-week, like I just mentioned. That's a huge risk management tool for me. It's my absolute favorite technical analysis indicator that supports not just trend trading, but like I showed you on multiple screens, right, side by side. I really want to see where the trend is, period, because why buy if you're in a downtrend? No, you buy on the way up and you sell on the way down. So candlesticks are helpful, moving averages, fib, all that stuff. But my biggest and best indicator is the 10-week EMA. And I recommend that all clients put that on their trading platform. It's free. You don't need to buy anything special. You don't have to use a special charting or trading platform. Pop that baby in and then watch. If it's chopping around it, there's no trend, no trade. Once it gets above it and stays above it, it's a beautiful thing. Once it goes below it, you know what you need to do, right? You need to manage your risk on the downside. It's the most important thing I can recommend. So for me, the whole point of this exercise in risk management is first and foremost having a durable trend. And then you can drill down into very, very tight time frames. So for example, the Q's sitting on this 200 week, just sitting there. We had a little bounce. You know, this is a very messy. I'm going to actually clean that up for you a little bit. No, I'm trying to get it off the, no, I don't have a clean one. Oh man. All right, never mind. All right. I want to get a really clean, all of mine have so many lines on it. I'm afraid to confuse you, but this is what I'm looking at right now. At the same time, I'm looking at Powell say that the pace of rate hikes will depend on incoming data. Well, if they were really dependent on incoming data, they would be extremely, we'd have a Fed funds rate at 8.5%. So also kind of dissecting Fed speak is really not easy. Anyway, getting back to this, there we go. All right, I just want to clean this up so you can kind of see. Microsoft, for example, I'm just going to use this as an example. On a weekly, on a day, and on an hour time frame, some are going to be very excited about trading a potential bounce. Like yesterday, we had a digestion inside, and then we had a nice bounce higher. 2.5% in Microsoft. Rithika made 100% on her calls. She announced it. She took it. She won. Doesn't always work out that way. But the point is, that's a very tight time frame, right? Mine is very different. I am very short Microsoft, NVIDIA, Tesla. The reason is I have already told you, I think NASDAQ underperformance is going to be intense. I also can see every attempt to come up to this 10-week rejected. The only time we had a solid reversal above it was last quarter, the end of quarter, short covering rally that was very much options expiration filled. The gamma turned positive and buying beget buying on 3.3 trillion in gamma, notional value in gamma coming off the board. So it allowed all those hedges, right? They had to be monetized. They had to cover. Market makers and the rest have a lot of optionality in the market. And that created that 2.5 week bump right into resistance. And then it rolled right back over with a gap down. So Microsoft has a weekly gap down. NVIDIA has a weekly gap down. Q's, I wish I had a clean one. You can't, has a weekly gap down. Doesn't look like it, but it is, right? So this is only a reversal and then a bounce into resistance and then another reversal. And we're sitting here just kind of quietly on the 200 week, but I don't trust it. I think, and I said this morning, we can get up to 283. Absolutely. Tomorrow's going to be another day though. Let's see what we do after we fill this gap, because that for me is setting up a really nice short the rip situation. And I'm going to use this 10 week as my guide, just like this was a perfect Morningstar reversal on a weekly, got right into that 315 and then got rejected firmly. So right now there's a little counter trend, short covering rally on the FOMC 75 basis point hike. And basically the market is monetizing some of those puts in the short term into into options expiration on Friday. And we have a short term, or what I call short-lived, short covering rally. So, but we have two big gaps. And I'm not so sure we're going to have the energy to get up there. But I let clients know, follow the VIX. This is exactly where I said it would be coming. That was a bearish harami. We would most likely come back down to this 29, 28 and change area. And here we are. So for the intraday, that's a chase. So have a theme, risk reward, in particular on the Qs, for example, low risk entry. If you're bullish for this short the rip theme, you want to go a little bit long, but on a tight leash and on a tight duration. But big picture, I'm just waiting for this to come back down, reverse, and then head higher. So we already did that once. See this trend line? Boom, boom, boom. And that's when I entered that VIX risk reversal, was literally on that tag. Okay. So now we come down, we filled that gap. Give it a little bit of time to kind of digest, curve around and head higher. For those who trade VIX, it's not everyone's cup of tea. TLT has been a fabulous continuation short. Every single rip has gotten ripped apart, and it continues to be very much weak sauce. It's on a kind of support. Didn't surprise me. It came right down to a monthly support level and bounced a little bit. But what happens when TLT goes higher? Equities will go lower. So we can't win for trying on this one. Bonds are broken. So bonds are broken. Dollar is not. Yields are softening on today's, hopefulness. But then they're going to go back to their tricks again. I believe very firmly oil will stay bid. Dollar will stay bid, yields will stay bid. Today, we will have an opportunity to see if they get defended. That's a really, really big point. But for the most part, I'm pretty confident they will. So risk management is very much having that confidence of a durable theme, first and foremost, an understanding of the market in a language that you understand, right? So I understood GameStop last July of literally 2020. That to me, I had April 12 calls way in advance. Recommended this to clients way in advance. It was my $4 to $40, and then I upped it to $60. Did I know it was going to 240 and then 480? Absolutely not. But the point is, when I have conviction on a trade, I'm going to post it for clients. And then there's a low risk entry using options with defined risk. And then you keep testing it. You keep testing it. And if the information changes, like in the case of this intense gamma-filled option-driven market for GameStop, then you change with it. But for the most part, this is the anomaly. This is not what happens every day. What happens every day is a grind. It's risk management in terms of testing your thesis, of setting price targets, of setting stop losses, and the mental health of not having too many trades at one time, the mental health of really having patience for your trade to play out. This took 6 months, the GameStop one, for example. So next is really, I don't know. What's next? What's next? I absolutely think that we're in a market regime change that will trigger volatility and more equity selling. Today, we have a little pause in that, but Bitcoin isn't pausing, right? It's at 22,000 on way to 15,000. That's my price target anyway. We have Tesla, which is absolutely going to be, in my opinion, falling into 500 this summer. So there isn't really a lack of opportunities here still on the downside. There are, seriously, Apple at 90, not a hard thing for me to envision. 122, to 106 to 93. We keep going. This channel is broken. So can we have intraday bounces that can fill some gaps like today? Let me break that down, actually, and kind of show you this. Sure, we can come all the way up to 137. Does that mean the trend reversal is on? No, no. It just means that it's going to have a nice bounce. If we get up to 141, that would be lucky. And then we can reshort it. So it's level by level. I happen to love this time frame congruence of week, day, and hour. And those are the most liquid plays within the mega cap tech. There are some proxies that I use that I don't trade, but for example, New York FANG, you can also see how we went up the mountain and now we're going down and every bounce is getting rejected. And here we have some nice stabilization the first, part of May into a bounce that got rejected. And now all we're doing is, chopping. Nothing convicting me to say that this trend is over. Nothing that says that this is a capitulation low. And nothing the Fed is doing right now gives me any confidence that they're going to fix what ails us, which is the selling that has been going on in the market since February of last year under the surface, into July, into November. We peaked and we're going right straight down. And that includes small caps, by the way. This is nicey, beautiful roll, but we are on some support. You see this 200 is very synonymous with a bounce. So taking some and having, some actionable short duration chases off of some key areas, but then knowing your risk reward, you're still in a protracted downtrend. If it makes it up to 296.45 in the Qs, that's where it hits its head. Doubt that it will close above there. That's my own, thesis. Be very, very suspicious, of media heads and the rest kind of with their mantra of it's always bullish, because the market over years has been very, very sustainably long-term bullish. 13 years of Fed QE. We're now in the exact opposite regime. It's tightening. It's currency risk. It's volatility suppression when you have quantitative easing, and it's volatility triggering when you have quantitative tightening. We have the tightening. So just kind of know your time frames. Don't get too overextended with longs, except if you have a particular one in mind that you love, that you really think is going to be the next, best thing. I don't know what that is. I don't marry any of my stocks. I'm very much dating only. So let me know if you have any questions that you want me to kind of size up. No, Dimitri, I think it is. So the rally will be crazy. What would make the rally crazy? What would actually create this buying frenzy that you're talking about? Valuations, Fed liquidity. In other words, they're going to cut rates and do more bond buying. What exactly is going to get the market to repair itself? Yeah. So there has to be more to this than just hope. Market thoughts that I posted yesterday, right? We can still have a short-term, short-lived, whatever you call it, short covering rally. But big picture, we still have yields that are spiking the most since 2008. The 10-year is above my 3.3% yield spike threshold. For me, that triggers 4.5%. Just like my oil call, even though we're absolutely softening today on this Fed hike, ironically, right? Perception is not reality. Oil is still, in my analysis, macro to micro, going higher. So 160 this summer, 260 crude by next year. Nothing has changed. This FOMC decision is not going to change that. The dollar above 105 is totally risk off. Oil year to date is up 62%. It's leading. So what's going to cause that to reverse? Credit spreads are widening. It's a big deal. Yield curves are coming down towards zero or inverting, which is recessionary tell. NASDAQ may be down over 30%, but this is not a capitulation low. More people that blurt it out will then create a wall of worry, but there haven't been a lot. Most are still looking for a rally. All of my intermarket analysis tells say there is no safe swing long, except for a few days. And the opposite, they all say air pocket of risk. So you need to give me that narrative of what's going to happen to cause the market to trust the ECB, the BOJ, and the Fed. Over in Europe, we have some solid swing shorts in the Eurozone on Germany, emerging markets, which happens to be a lot of China. And I did it twice. Oh, interesting. It's supposed to say Japan. Anyway, they work extremely well. The euro has been a phenomenal short. There's a lot of collateral damage going on over in the EU. It's not a problem that's going to go easily away. So this coordinated central bank intervention today, with Bank of Japan buying lots of bonds to control their yield curve, with the Fed raising more than expected, so guidance is out the window, and the ECB, of course, talking up that they're going to get aggressive when in fact they really have a hard time getting aggressive. There's nothing here that has changed any of my prior warnings to clients. The rate of change analysis in my intermarket says Fed and inflation are both unanchored. Yields will move much higher as bonds sell off. What normally takes years to unwind will now take months as bonds are stocks without circuit breakers. They both sell off together. This is still my main mantra, no question. So you can see how I am presenting this information for clients and how my trading desk also presents their analysis and trade setups for clients. This is all available in what we deem my fishing club membership. And you can see that normally this is $350 a month, annual, $3,500 a year. Mad Hedge Fund participants who have stayed for this presentation to get a little bit more of a feel of how I do my market timing analysis and education and calls can get this for 3 months for just $7.99. So this is definitely the deal. This is not offered elsewhere. It is a short duration deal. You get to save by taking this deal that will go away in a few moments. After this presentation, you have some time to take a look at it, think about it. You've got my market commentary. You've got a team of pro traders, hedge fund managers, and you basically have all of this access available 24/7. I'm very active in posting, and I run a live trading room, right? So I mean, this is not lightweight. Just I'm going to give you fluff. I'm only going to post when I have something to say. There's going to be inflection reports. There's going to be analysis that absolutely means something to sector rotation, volatility, global assets. This is a deal for 3 months, $7.99. I highly recommend it. My clients can highly recommend it. Even my clients who have clients can highly recommend it. Case in point, this was sweet. I have a JP Morgan wealth manager who gave me a little kudos in direct message, which I thought was really sweet. And he's managing a lot of money. So I know that I'm helping him manage his clients' money, right? So this is literally, he wrote this to me in DM, and he's, got all kinds of reasons to go consensus. I'm not consensus. I worry about tail risk. And I'm very, very very much concerned about protecting clients. So you get me, you get my other contributors, you get a lot of value, you get a community also of support and other clients who are just really fabulously contributory in membership chat or in my live trading room. And again, this is a mix of retail and institutional. So I highly, highly recommend joining and making a big difference to your active trading and your active investment results. And I thank you very much for your time today.
All right. Well, thank you very much. Always fascinating. If you want to take advantage of Samantha's offer, the link is in the chat box on the right. It says LaDucTrading.lead pages. And you're always great. People love you.
Oh, thank you very much. And if it doesn't work, I've got to find out from James. He's obviously got to fix that. We had lead pages actually had a breakdown today. Literally, they sent out a support request. So this was an immediate fix because their page went down. So if it's not working,
I just clicked on it and it works.
It comes out, unfortunately, with a checkout price that's different. So yeah, support at LaDucTrading.com. We'll see what happens with, maybe James will see this and fix it, but apologies if that's not exactly right.
You know, the second ever summit we ever did, all of Zoom crashed. And we had a real high-end speaker from Australia, you know, who was living in some shack up in Bangkok. And, you know, we were communicating with him in Bangkok, communicating with Zoom in Santa Clara, and everyone was running around with it like a chicken with their head cut off. And what had happened, it was the first day of school for almost all of the United States, and every school in the country was using Zoom.
Oh, yes.
To start the pandemic school year. And Zoom said they were preparing for 100-fold increase in business. It wasn't enough. And they were down for 2.5 hours. And finally, they went back up and we started our summit. So.
And that was peak earnings as well, that particular month.
You know, if you're in a summit business, you have to be ready for all things at all times.
Well, I am very grateful if you stick with it, because like I said, we'll make it good. We just might need to get support on the line and they'll fix it. In any case, I wish you all a fabulous summer and be safe out there.
Same here. Same to you.
Thank you.